Welcome to the deep dive. Today we're taking a closer look at Aptus Value Housing Finance.
That's right.
We're working off a pretty detailed research report from Centrum Broking dated May 7th, 2025. It's all about this Indian non-banking financial company, a big name in value housing
Yeah,
finance.
they focus specifically on that segment.
So our plan today is really to, cut through the numbers and the jargon. We want to pull out the key insights, the things that make you go, aha, about how Aptus is doing and maybe where they're headed.
Exactly. This report's quite comprehensive, goes deep into their financials, their operations.
Hmm.
So we'll try and guide you through what really matters, what the signals are for the company's future path.
Okay, great. So the report starts naturally with financial performance, and the numbers look pretty robust on the surface. What really jumped out at you?
Well, right off the bat, you see that 26% year-over-year jump in net profit came in at Rs 2.1 billion. That's a strong headline figure.
Yeah, definitely catches the eye.
And it's also a solid 9% just from the previous quarter. So it shows good momentum. And it was pretty much what analysts were expecting, broadly in line.
Okay, and what's driving that profit growth?
A big part is the growth in their assets under management, their AUM. That's the total value of loans they manage, basically.
Yeah.
It grew by a significant 25% compared to the previous year.
Right. And it wasn't just the total loan book growing, was it? I saw something about the pace of new loans, too.
Absolutely. Their disbursements, that's the new loans they're actually giving out, they were up 10% year over year.
Okay.
Even stronger growth quarter over quarter, up 14%.
Okay.
So, yeah, it suggests they're actively writing new business, and there's clearly still demand out there for their financing.
Now, there's a specific mention here about their net interest margin, the NM. It got a noticeable bump, and it seems like one particular transaction was key. Can you unpack that a bit?
Yes, that's quite interesting. The on their average earning assets, it jumped 32 basis points just in the quarter, hitting 12.0%.
That's a big quarterly move.
It is. And the report flags this direct assignment, or DA, transaction. It was in their non-housing loan portfolio, worth about Rs 750 million.
Uh-huh.
And apparently this was the first time they've done a DA transaction like this. Essentially, they sold off a chunk of these loans. And the accounting treatment for that gave a real boost to their interest income for this specific quarter.
Ah, okay. So a strategic financial move that kind of flattered the NIM figure this time around.
Exactly. It had a direct positive impact on reported profitability for Q4.
Interesting. So beyond that specific boost, how are their broader profitability metrics looking, the returns?
Even looking past that, the picture's pretty good. Their return on assets, the ROA, is sitting at a healthy 7.9%. That shows they're making good profit from their assets.
Right.
And the return on equity, ROE, is even stronger,
Yeah.
19.7%. So good returns for shareholders.
And those are improving.
Both are showing improvement compared to last year. Yeah. Signals better efficiency. Plus, their capital adequacy ratio, CR, that crucial safety buffer, it's still very strong at 70%.
70%. Wow, that's high.
Very comfortable cushion. Yeah. Plenty of capital to absorb potential shocks.
Okay, let's circle back to that AUM growth. You said 25% year over year. Where is that growth coming from geographically? Is it spread evenly?
Good question. It's not entirely even. The total AUM hit Rs 108.7 billion. But you see particularly strong year-over-year growth in places like Andhra Pradesh, up 31%.
Okay.
Telangana, even higher at 33%. And Karnataka, also strong at 25%.
What about Tamil Nadu? That's usually a core market for them, isn't it?
It is, and the report notes a revival there. It saw a solid 6.2% growth just in the last quarter. So it looks like Tamil Nadu is maybe getting back on track. These are definitely the key states to watch for their growth story.
And they're supporting this growth by expanding their physical footprint too, right? Branches?
Exactly. They didn't stand still. Added 2 more branches sequentially last quarter, bringing the total count to 300.
300 branches.
Yep. And the plan for this fiscal year, FY26, is to add another 40. So that branch expansion is clearly a core part of their strategy to hit those growth numbers.
And speaking of growth numbers, their target seems, well, quite ambitious. Rs 250 billion in AUM by FY28.
It is definitely ambitious. That implies needing a compound annual growth rate, a CAGR, of 30% per year.
30%.
Yeah. Now, while that's the company's goal, the Centrum analysts are projecting something a bit more conservative. Still very strong, mind you, but they're forecasting an AUM CAGR of around 26% between FY25 and FY27.
Okay. A slight difference in outlook there. Interesting. What about the types of loans they're giving out? Is it mostly housing?
The report breaks it down pretty clearly. Housing loans, proper HLs make up the biggest slice, about 60%.
Okay.
Then you have quasi-housing loans, maybe loans against property, things like that, 14%.
Yeah.
And small business loans, SBLs, make up about 20%.
And all segments are growing.
Yes, importantly, all three showed year-over-year growth. So it's not just one engine firing. It seems pretty broad-based across their different loan types.
And the company sounds confident they can keep this kind of pace up.
They certainly project confidence. Aptus management is guiding for AUM growth around 28–30% in the coming years.
Right. Close to their target TAGR.
Exactly. They reckon it'll come from a mix of things, the expanding branch network, obviously, but also an increase in the average ticket size, meaning slightly larger loans on average, and just digging deeper into their existing markets as well as the new areas they're opening up.
Okay, let's get into the profitability weeds a bit more. We mentioned the NIM bump, but what about the underlying spreads and their borrowing costs?
Yeah, so interestingly, despite the NIM jump from the DA transaction, their reported spreads, the gap between what they earn and what they pay for funds, were actually flat quarter on quarter at 8.71%.
Okay.
Their overall yield on assets was 17.39%, while their cost of funds, COF, was 8.68%. So that difference is the spread.
Got it. And the core income from lending, NII.
Net interest income, NI, grew strongly, up 26% year-over-year, 9% quarter-over-quarter, pretty much tracking that AUM growth we talked about.
But you mentioned the analysts see the NIM potentially coming down a bit, despite this recent quarterly jump.
Yes, that's a key point in the analyst forecast. Centrum expects NIM to dip slightly, maybe to 11.8% in FY26 and 11.5% in FY27.
Why is that?
Their thinking seems to be tied to leverage. As Aptus grows, they'll likely need to borrow more to fund that loan growth. Increased leverage might mean their average cost of funds edges up a bit over time, putting some gentle pressure back on the NIM.
Makes sense. What about keeping control of their own operating costs as they add all these branches?
The report shows a slight increase there. Operating expenses to average assets edged up to 2.58% in Q4. You'd expect some increase with expansion, hiring, new branches.
Sure, that's natural.
But despite that, their bottom line, the profit after tax, PIT, still showed that strong growth we mentioned earlier, Rs 2.1 billion, up 26% year on year.
Okay. Let's shift gears to asset quality. Crucial for any lender. How are they managing loan risk? Any warning signs?
Generally, the picture seems pretty stable, actually. They're stage 3 assets. These are loans with a higher risk of default. Essentially, NPAs were at 1.18%.
How does that compare?
It's a fraction higher than the previous quarter, just slightly up, but still a relatively low number in the grand scheme of things for this sector.
And earlier warning signs, like loans just starting to go overdue.
Their 30-plus days past due, DPD, stood at 5.91%. And encouragingly, their credit cost, the amount they set aside for potential losses was actually lower this quarter at 0.31%.
Okay.
And they seem consistent in how they provision for potential losses.
How so?
Well, their overall expected credit loss, or ECL cover, is around 1.03% of their book. And specifically for those stage 3 assets, their provision coverage ratio, the PCR, has been held steady at 25% for like the last 14 quarters straight.
Wow, that's consistent.
Yeah, it's just a stable, maybe quite prudent approach. And importantly, management stated on their call that they aren't seeing any specific pockets of stress, no asset quality issues flaring up in any particular market or geography.
Good to hear. Okay, so that's the company's performance. What's the verdict from the analysts looking at all this? Centrum Broking seems positive?
Very much so. They've maintained their BUY rating on Aptus, and they've actually bumped up their target price. It was Rs 489, now it's Rs 457 per share.
And based on the price when the report came out?
Right, the market price was Rs 317 back on May 7th. So that new target price of Rs 457 implies a potential upside of 44%. Pretty significant.
What's driving that confidence? Why raise the target?
Their rationale is based on assigning a multiple of 4 times price to adjusted book value on their forecast for FY27 earnings.
Okay. And the core reasons for the positive stance?
It really boils down to a few key things. The consistent, strong growth trajectory Aptus is on, their profitability metrics, which are, frankly, industry-leading in many cases, and their tight grip on asset quality. They see that combination as quite compelling.
Now, there was an interesting point in the report about interest rates. It suggested Aptus might actually benefit if rates start falling. How does that work?
Yeah, this is potentially a really key factor for them going forward. The report highlights that around 80% of Aptus's loan book is on fixed interest rates.
80%, okay.
So think about it. If general market interest rates were to fall, the rate Aptus earns on most of its loans wouldn't change because they're fixed.
Right.
But their own cost of borrowing could potentially decrease as market rates fall.
Ah, so their income stays stable, but their costs go down.
Exactly. That difference would widen their net interest spread, boosting profitability. And management apparently expressed confidence they could manage their borrowing costs effectively in that kind of scenario, too.
That's nice potential tailwind for them. The report also pulled out highlights from Aptus's recent conference call. What were the key messages there?
Yeah, a few things stood out. That direct assignment transaction we discussed,
Yeah.
definitely a talking point, how it boosted non-interest income.
Sure.
They also reinforced the message about improving asset quality trends. And they highlighted strong customer acquisition. Their customer base grew 21%.
Okay. Did they give specific guidance for this year, FY26?
They did. They're projecting a cost-to-assets ratio between 2.63% and 2.7%. For credit costs, they're guiding around 45 basis points. That's gross, before any bad debt recoveries.
And growth targets, still aiming high.
Yep, reaffirm the AUM growth target of 28-30% and disbursement growth of 24-25%,
Mm,
and confirm the plan for 40 new branches this fiscal year.
got it. They also mentioned something about a tech upgrade affecting last year's numbers slightly.
That's right. Management explained that the disbursement growth in FY25 looked a bit lower, reported at 15%, partly because of a tech upgrade that caused some disruption for about a month.
Ah, okay.
They estimated that without that, the adjusted growth would have been closer to 18%. So, bit of context there.
Any comments on their main markets during the call, like Andhra Pradesh or Tamil Nadu?
Yeah, they sounded positive,
Mm.
emphasized that the opportunity in Andhra Pradesh is still huge, lots of potential,
Right.
and they see Tamil Nadu getting back to normal, showing positive signs. So it suggests continued confidence in their core states. They also mentioned something interesting about their funding. A good chunk of their bank borrowing is locked in at fixed rates for at least 5 years. Gives them some stability on the cost side.
Right, ties back to that interest rate point.
Exactly. And that high fixed rate loan book, again, positioning them well if rates do fall. Oh, and one more thing on the DA transactions.
Yes.
They plan to keep doing them. Roughly Rs 1 billion to Rs 1.5 billion each quarter. They see it as useful for diversifying funding, managing their asset liability match, and maybe gradually shifting their focus even more towards the core housing loan book over time.
Okay, strategic tool for them. Lastly, the report touched on how Aptus compares to its peers. What's the takeaway there?
When you put Aptus next to competitors like, say, Avis Financiers or Home First, Aptus generally shows a really strong return on equity. Their ROE stacks up very well, often better.
And valuation. How does it look compared to peers?
Their valuation multiples, like price to book or price to adjusted book value, seem to be broadly in line. They're within a competitive range compared to the others in the value housing finance space. So, the market seems to be valuing them similarly, despite maybe stronger ROE in Aptus's case sometimes.
Okay, so let's try and wrap this up. Bring it all together. What are the really essential takeaways from this deep dive into the Centrum report on Aptus?
I think the key things are, first, Aptus is showing really strong financial health. You see it in the profit growth, the AUM expansion. Second, they seem to have a good handle on asset quality, keeping it stable. Third, the analyst outlook is clearly positive, seeing significant potential upside.
Right.
And the strategic moves, like using those direct assignment transactions and the continued focus on expanding their branch network, seem to be key pillars supporting their performance. And of course, that potential advantage from their fixed rate loan book if interest rates decline is definitely something to keep an eye on.
Absolutely. Okay, and now, as always, a final thought for you, our listeners, to mull over. We've talked a lot about Aptus's focus on fixed-rate loans and how analysts see potential margin improvement if interest rates fall. So thinking longer term, beyond these specific forecasts, how might broader shifts in the Indian economy or significant changes in interest rate policy really reshape Aptus's profitability and growth path? And what other factors, maybe things not explicitly detailed in this report, like competition heating up or regulatory changes, could play a really pivotal role in their performance in the coming years? Something to definitely keep thinking about if you're tracking Aptus Value Housing Finance. Thanks for joining us for this deep dive.